All right, let's jump right in. We're going to tackle one of the biggest, most stubborn puzzles in all of finance: stock market momentum. Seriously, for decades, this thing has been a total head scratcher for economists, but at the same time, a goldmine for traders. And the mystery, when you boil it down, is actually pretty simple. Why is it that winning stocks just keep on winning? A stock that's had a great run shouldn't necessarily keep having a great run, right? At least not in a perfectly efficient market. But the weird thing is, the data year after year shows that it does. So to put a name on it, what we're really talking about here is price momentum. It's this well-documented tendency for stocks that have been on a hot streak to, well, stay hot. And on the flip side, stocks that have been doing poorly tend to keep doing poorly, at least for the next few months. Now, for the longest time, whenever anyone tried to solve this puzzle, there was always one prime suspect. And that suspect was us, people. The idea was that momentum wasn't some deep market secret, but just a glitch in our own brains, a flaw in our collective investor psychology. And this behavioral explanation usually blames a few specific things. Like there's conservatism, which is just a fancy way of saying we're slowpokes when it comes to changing our minds, even when new info comes out. Then you've got this self-attributive overconfidence. That's when we think our wins are because we're geniuses. And sometimes it's just that news, good or bad, takes a while to spread around. But what if we've been looking in completely the wrong place this whole time? A really fascinating paper by Liu and Zhang comes along and suggests something totally different. They say, hey, maybe the answer isn't in our heads. Maybe it's inside the companies themselves. So this really sets up a showdown between two big ideas. In one corner, you've got the old champ, the behavioral view, which says this is all about our emotions and biases. And in the other corner, you have this new challenger, the investment view, which says, nope, this is all perfectly rational. It's about smart companies making smart decisions. And the whole idea behind this new model boils down to this one core principle. It basically says that a stock's return should mirror the company's investment return. And what does that mean? Well, it's the actual profit the company makes from its real-world projects. Building a new factory, launching a new product, that kind of thing. Okay, so how on earth can a company's decisions create momentum in its stock price? Let's pop the hood and take a look at the engine room to see how this whole thing is supposed to work. Think about it like this. Let's say you have a baker, and her bread suddenly becomes the talk of the town. Sales are through the roof. What's the logical next step for her? She invests in a bigger, better oven to bake more bread, right? Well, the promise of all those future bread sales, that future profitability, makes her whole bakery more valuable right now. The success fuels the investment, and the investment justifies a higher value. So you can see how this creates a kind of chain reaction. Step 1, a company's stock starts doing really well. It becomes a winner. Step 2, that strong performance isn't just random luck. It's a signal to everyone that this company is expecting some serious growth. Step 3, the company sees that signal too, and it invests more money to chase that growth. And finally, step 4, the profits from those smart investments prove that the high stock price was justified. It all feeds on itself in a perfectly logical loop. And according to the model, this whole effect really boils down to two key things. First, winners have higher expected growth. They're just planning to invest and expand way more than the losing stocks. And second, they have higher expected profitability. They're simply better at turning every dollar they invest into sales and profit. Okay, the theory sounds pretty solid, right? But here's the million-dollar question. Does it actually match the data? Let's put this new model to the test and see if it can really crack this case. First, let's remember just how big this puzzle is. If you just bought the winning stocks and sold the losing ones, you'd have made, on average, over 15% per year. That is a massive number. And that's the anomaly that needs explaining. And this is where it gets really crazy. When the researchers ran their model based on company investments, how much of that 15% profit was left unexplained? Get this, just 0.4%. A tiny, tiny fraction. Let me say that again. This model, which is based completely on rational decisions made inside of companies, explains over 97% of the entire momentum puzzle. It's a near-perfect explanation, and it does it all without even whispering the words investor psychology. But wait a second. A good theory can't just explain the crime. It has to explain the whole story. And a huge part of the momentum story is that it doesn't last forever. In fact, after about a year, it tends to fizzle out and even go into reverse. So can this new investment model explain that part of the puzzle too?
So if you look at the data, momentum profits start off really strong, then they get weaker over time, and eventually they even turn negative. And what does the model predict? It's incredible. It almost perfectly maps that decay, and it predicts that the profit should disappear right around month 15, which is almost exactly what happens in reality.
And the explanation for why it fades is just elegant. The key ingredient in the model, that amazing growth advantage that winner firms have, it's not permanent. I mean, think about it. No company can grow like crazy forever. The paper shows that this special growth advantage pretty much disappears after about 13 months. And just like that, you have a perfect explanation for why momentum has an expiration date. Okay, but let's be real, no theory is ever perfect. And one of the great things about this paper is how honest the authors are about what their model can't do. So let's look at the clues that are still left on the table. They state it right there in the paper, loud and clear. The model struggles with two specific things, something called the procyclical of momentum and its weird interaction with book-to-market or value stocks. So what does that actually mean? Well, first, the model can't figure out why momentum works so much better right after the market has been on a big upswing. And second, it doesn't get this strange relationship between momentum and value stocks. For some reason, when momentum is hot, value investing is not, and vice versa. These are still big, unsolved mysteries. So, after all that, what's the verdict? Where do we stand on this huge debate? Are markets rational or are they irrational? Is it all about logic or is it all about psychology? Look, the big takeaway here is not that investor psychology is totally irrelevant. Of course it matters. The real point is that momentum, which for years has been the poster child for irrational markets, might not be the smoking gun we all thought it was. We now have a really powerful, really compelling, rational explanation that we have to take seriously. And that leaves us with one last big question to chew on. The next time you see a stock on a tear, what are you actually looking at? Is it a bug in our own human software? A glitch in our brains? Or is it just the natural, rational reflection of a great company doing great things? This paper makes a pretty strong case that the answer might be a lot more logical than we ever gave it credit for.